So I am looking at this, and Sigma Lithium literally turned its own trash into treasure to dodge a liquidity crunch this quarter. I mean, welcome back to Earnings Unscripted. Today is March 30th, 2026, and we are digging into Sigma Lithium's Q4 2025 numbers. Ticker is SGML. And Miro, they literally survived by selling off their waste tailings piles. What kind of quarter was this?
It was an absolute high-wire act. I mean, they pulled off a magic trick, but you look under the hood and it is just chaotic. The CEO is out there calling the company a cash machine, but they also just got hit with an adverse opinion from their auditor and a massive going concern warning.
Which is exactly why we need to remind everyone really quickly that we are definitely not financial advisors, and all of this is just our personal opinion and not investment advice, because honestly, trying to trade this based on our banter would be terrifying.
Truly terrifying. Yeah, but look at the revenue. Top line came in at $16.9 million. That is down roughly 41% quarter over quarter from $28.5 million. And yet gross margin violently flipped positive.
Right, $13.1 million in gross profit, up from a $1.5 million loss last quarter, which makes no sense until you realize they aggressively targeted higher provisional prices. Plus, that new business line, they are just selling the lithium fines, the low-grade dust they had piled up.
Exactly. Their premium high-grade production actually dropped about 24% for the year. They halted mining to replace their third-party contractor. So they pivoted to selling the scrap. That move saved the gross margin, and the operating loss actually improved from negative $9 million in Q3 down to just negative $1.6 million.
Net income actually got worse though, right?
Yes, net loss expanded to $24.4 million because firing that contractor, it triggered a sudden $6 million idle capacity charge. So diluted EPS dropped to negative 22 cents. That is significantly worse than the negative 10 cents last quarter.
Ooh, okay, but the market did not care at all. The tape was wild. The stock already gained, over 100% during the quarter?
Roughly 106% leading up to the report. And then on earnings day, it just gapped up. Strong pre-market momentum pushed it around $13 before the call. It briefly spiked above 14 in the regular session. It faded heavily from the open, but it still held an almost 14% net gain from the previous day.
Investors totally bought the cash machine story, which, to be fair to management, their environmental angle is genuinely brilliant. I was reading they take those waste rock piles, the dry stacked tailings, and they run an artificial germination program to just plant foliage directly into the rock. They're basically growing green mountains out of mine waste.
It is fantastic marketing. They brand it quintuple zero lithium, zero tailings dams, zero hazardous chemicals. But you can plant all the trees you want on a waste pile. You still have a massive negative working capital problem. The GAAP cash flow from operations was $8.9 million, but management is out there touting a pro-forma $31 million.
Okay, yes, let us stop right there and get into the details on that, because the gap between those two cash flow numbers is doing a lot of heavy lifting.
Heavy lifting is an understatement. I mean, when Anna Cabral got on the call, she actually said, quote, "We are a cash machine. We burned zero cash." But to get there, management had to invent a completely new metric. They call it cash pro forma.
Okay, cash pro forma. That already sounds like someone is grading their own homework. What is actually in that number?
Pure magic. They take the actual GAAP operating cash flow, which was just $8.9 million, and they just add back $41 million in uncollected customer receivables. Then they subtract $10 million in debt interest, and suddenly you have a shiny $31 million figure on slide 18.
But you cannot spend an uncollected receivable. Like, if a customer owes me money, I cannot use that to buy groceries today. How do you pitch that to investors as actual cash generated?
You put it in a footnote, and you rely on the fact that retail investors look at the big font and ignore the fine print. But you know who does not ignore the fine print? The auditor.
I'm Grant Thornton, right, because they handed them an adverse opinion on internal controls, which is a massive institutional red flag. That does not happen to companies that just have a couple of messy spreadsheets.
Exactly. An adverse opinion means the controls are fundamentally broken. Grant Thornton specifically cited an insufficient number of trained personnel with the appropriate skills. They also called out ineffective risk assessment and, well, this is the best part, insufficient board oversight.
Wow. So the CEO is calling it a cash machine, while the auditors are essentially saying the adults have left the room.
Yes, and the timing is just brutal because they are staring down a massive liquidity wall. That is the real reason the auditor stamped them with a going concern warning in the 10K.
Right, the synergy loan.
The synergy loan. It's a $100 million export prepayment debt. It matures in December 2026, so it just got reclassified as a current liability. That instantly collapsed their balance sheet into a working capital deficit of $151.2 million. Negative.
Jeez. Okay, so they owe $100 million next year. They only have $6.2 million in cash sitting in the bank right now. How exactly do they plan to bridge that gap?
By asking future customers for prepayments. Cabral said on the call, quote, "That debt will be replaced by an offtake, which is a very sound and very logical operational move," end quote.
Wait. Replacing an expiring loan by taking advances from someone else to buy future production? That is just refinancing with extra steps. Or hoping the spot market for lithium does not collapse again.
Spot on. It is highly leveraged optimism. And meanwhile, they are bleeding cash and totally unforced errors. Remember how we mentioned that $6 million idle capacity charge?
Right, from halting mining so they could bring it in-house. They fired the external contractor.
They fired Fagundes. They completely took over the fleet. The CEO pitched it as a big cost-saving win. She said, quote, "We race our own race without looking to the sides." But firing the contractor triggered an immediate $25.6 million legal standoff. The contractor initiated arbitration, and Sigma had to record that entire disputed amount in their accounts payable to stay compliant.
Okay, let me process this. They fired the contractor to save money. That caused them to halt production, which created a $6 million penalty on the income statement. And now they are locked in arbitration for $25 million anyway.
Pretty much. They leased custom iPads for the pit operators and hooked up self-learning AI bots to map the mineralogy. The tech sounds incredible. I mean, physics-based, dense media separation, AI adjustments on the fly, but the actual business foundation underneath all that technology is basically running on IOUs and lawsuits.
You are building a green mountain, but the foundation is literally just unpaid supplier invoices. It is fascinating, but it is incredibly precarious.
Precarious is the polite word. The market loves the narrative of the low-cost, sustainable producer. And to be fair, selling the lithium fines this quarter was brilliant. It saved the balance sheet. But a going concern warning is not something you can just market your way out of.
So if their only lifeboat is getting $100 million in customer prepayments over the next 12 months, what happens if buyers just walk away? Where does this leave them heading into the next few quarters?
Well, if buyers walk away, the math just breaks. But management they are projecting absolute confidence to make sure that does not happen. They actually guided to 240,000 tons of production for 2026.
Right. And they want to scale that up to, what, over 500,000 tons by early 2027? Whenever phase 2 comes online?
Exactly. And this is where the outlook gets highly aggressive. Cabral threw out a scenario on the call saying, quote, "If lithium retrocedes to $1,500 a ton, we are going to be generating about $158 million in free cash flow after interest."
Okay, so she is basically drawing a psychological floor for investors, just telling them even if the commodity market tanks, we're still safe.
Right, she's setting a floor. And if spot prices stay near current levels, she claimed they could generate up to $260 million. So the whole trajectory here is, well, it entirely relies on keeping their all-in sustaining cost clamped tightly around $592 a ton.
Which is a great model on paper, but honestly, given the auditor throwing flags and that abrupt transition to an internal workforce, assuming flawless execution right now feels incredibly generous.
Oh, it is a massive trust me trade. They completely depend on landing these prepayment deals, including a pending $50 million one, to bridge their capital needs without diluting shareholders. If they pull it off, it's a brilliant corporate maneuver. But if they slip on costs,
then gravity finally catches up to the Green Mountain. It really is a fascinating game of chicken with the broader market.
Yeah, and for today at least, the market blinked. We just have to see if their internal controls can actually catch up to their ambition by next quarter.
Very true. I guess we'll be reading those future footnotes even closer. We should probably wrap it up there for today.
Sounds good.
Catch you all next time.
If you want to catch these deep dives the moment they drop, just go ahead and follow the feed wherever you happen to listen. We actually generate this show with the help of AI, which is exactly how we can scan through hundreds of pages of filings to find those hidden footnotes so fast. Let us know what company you want us to pull apart next by emailing earningsunscripted@datamadness.ca or just click the X link in the show notes.
Talk to you next time.